All right, guys. So risk management, or how much you're risking, is how much you're basically willing to lose on that trade. And we had a video on calculating risk, so you can figure out how to actually mathematically figure out what risk works best for you. But now we're going to be talking about risk management and position sizing. Your risk is how much money you're willing to lose if you're wrong, and your position size is basically like how much contracts you have according to that same amount of ticks that you're risking. Once again, if you're confused, watch the previous video. All right, guys, so I mapped out 3 types of risk in terms of risk management and what should be going through your mind on which one you choose. Okay, so we have a fixed dollar risk. Very simple. Maybe you're on a $50,000 trading account, trading with a prop firm like Top Step, and you're saying, I'm going to risk $500 per trade. What does this mean? It means that it stays the same. So if your account goes to $52,400, you're still risking $500 per trade. If your account drops down to $49,400, you're still risking $500 per trade. This is why we call it a fixed dollar risk, meaning that it's mainly focusing on the amount of dollars that you're risking per trade, and it's not focusing on these other things that we're going to tap into next. So the next thing you have is percentage risk. Now this one is a really good one because this one is more about percentage. So simple math, when you have a $50,000 trading account, and I keep using that example, guys, because that is probably the average account most of you guys trade, especially with prop firms. So and don't worry, we will have a whole video on how to trade prop firms, how to get payouts, how to scale them, how to hit 10K months, 20 up to $40,000 months with prop firms. But percentage risk, okay? This one is all about the percentage. It is not about the dollar amount. As you see, I have here, as the account grows or shrinks, the dollar risk adjusts with it. So pretty simple. If you have a trading account that's $50,000 and you tell yourself, I'm going to do 1-to-1s, which means I'm going to risk 1% on each trade and try to, make 1% as well. Well, you're going to be at $500. But if that account goes to $51,000, well, now that has changed to $510. Now, if that account goes up and up and up, you see how that risk slightly changes, so on and so forth. The more your account goes, you're basically risking more, but it's not really risking more because it's still in the contains of I'm risking 1% of this account. Personally, I do the fixed dollar risk. I'll tell you guys why later on, but let's look at the last one. Now for the last one, we have variable risk. Now this one I should have actually put around it that this one is only for experienced traders, but I still want to go over it just so you guys can have the idea in your mind as you guys get more experience and better on the charts. So let's get straight to it. Variable risk is your maximum is $500, but certain setups might only warrant $250 or no trade. And I didn't write full detail on this, but maybe certain setups you're willing to risk $1,000. So it's literally depending on how A+ the setup is. If it's an A++ setup, maybe you're willing to risk $750. I don't recommend that, but maybe that's what you're willing to do because of the variables, because of the situation, and vice versa. If the trade seems a little bit more risky, maybe a B setup, maybe you're like, I'm only gonna risk $250 here and break even and then hop back in for another trade if I see something else because we're choppy right now for another $250. Right, so now you split up 2 different entries because the market's not the best price action. That's variable risking, and that is the more experienced version because you're going into the market and you're not even knowing exactly how much you're going to risk that day. You know how we talked about having our stop loss above confirmations. So let me show you guys a perfect example. Say right here, we wanted to enter for this trade right here, beautiful fair value gap, right? Okay, we get the break of structure right here. Let's go down to the 1-minute time frame. Just showing you guys this in action, okay? Please pay attention. All right, boom, we get our break of structure right here. Now, see what I mean? Okay, say you're like, okay, I'm on a, mini account, NASDAQ, I only want to risk $500. Well, you're right here, but your confirmation is actually up here. So a lot of people, they will say, you know what? I'm probably going to scale down to micros or something so I can have my stop right here, because it probably wouldn't be smart to risk 277 ticks. With one contract. But you see the point. If you want to truly respect the setup to the best of your ability so that if you lose, it's actually because of the setup being wrong and not because of a stop loss issue, variable risking is for you. But just make sure you know how to maneuver between micros and minis so that you're not risking that much in the end of the day. Okay. All right, guys. So some basic risk management things is basically just making sure you are not losing more than you are winning on each trade. What do I mean? Okay, just looking for random confirmations, right? This is not an actual strategy, but let's say we waited for an inverse here, then we entered. Okay, we enter after this candle right here. Let's say we wanted to go for 75, 76 ticks at this resting liquidity up here for our take profit, and we wanted to risk let's say 50 ticks for whatever reason. Okay, well guys, at this point you got stopped out, but what's most important is that you are able to win more on your winning days than on your losing days. This is a little bit of trading psychology, but also goes into risk management slash just being able to control your capital. Because, this is why people obsess over 1 to 2s. Even with this example, what if you really had your take profit up here at this resting liquidity up here, right? Which is a great take profit, okay? All right. You may be in a situation where you're like, cool, maybe you got stopped out. But notice how much you're trying to make here. So what's going to happen is it's going to take 2 losses to basically equal the same amount as 1 win, right? And that is really good risk management. This is why people obsess over 1 to 2s. I do want to say though, if you do want to trade 1 to 1s, you have to be willing to have a really good win percentage. Because think about it, out of 10 trades, if you win 5 and lose 5 and you're winning the same amount as you're losing, well, you're just a break-even trader. But let's say you win 8 and you only lose 2. Let's say each of those 8 trades were $500 wins. Well, now you're up $4,000 minus the 2 losses, $1,000. You're up by the end of 10 trades, net profit of $3K because you have such a high win percentage. But I mean, I think the best of both worlds would be, the most best thing you can have, because what you would want to see at that point is a high win rate and a high risk to reward. Meaning that you're, winning a lot and you're also winning a lot each time you're winning, if that makes sense, right? Quote unquote, a lot, right? Each time you're winning a lot of profit, right? So, this is what I mean. So your basic risk management would want to be, okay, say once again, we wanted to stay under this confirmation, 50 ticks. Your take profit should at least be 50 ticks. That isn't even up for discussion. So it's not, okay, maybe I only want 30 ticks. No, that is horrible risk management. Your minimum needs to be at least 50 ticks because your stop loss is at 50 ticks. Now, once again, I'm not really a fan of this type of trading, but if you are and you have a good win rate, go for it. If not, you would probably want to go for 100 ticks, because once again, now you understand, okay, maybe I lost today on Monday, but I know that I need to lose 2 times to even equate to what I'm about to win on Wednesday. You feel me? And now if you're on a win streak, you win 3 times in a row, you're up $3,000 because maybe you're winning $1,000 each trade. And now you understand that it takes double the amount of trades just to break even on how much you just won and lose all that because of your risk management. This is why it's so important. So some basic things, just to make things simple for you guys, on the E-mini futures will be 1 to 1, right? Having your take profit at $100, having your stop loss at $100. This would be risking 500 to make 500. I'm sorry for the terrible fucking handwriting. Okay. Let's do 1 to 2. This would be risking $100. Well, sorry, 100 ticks, which would be $500 to make $1,000. So now you have a 200 tick take profit and a 100 tick stop loss. Okay, as you see, you're literally winning double the amount that you're risking. So it's like it evens out as long as the win rate checks out. You can't have a 30 to 40% win rate and do 1 to 2s and be like, I'm good. But at that point, you're better off just trading 1 to 1s. And your strategy is probably more profitable doing that. But if you have a solid like 60% win rate or up trading 1 to 2s, bro, you're literally good, bro. So that's 1 to 2s, and then so on and so forth. I'll show you guys one more. You have 1 to 3s as well. Same thing, right? Same idea. You're risking 1% of your account to make back 3% of your account. This is what it will look like on E-mini NASDAQ, 300 ticks. I'm only going to show you guys for NASDAQ, not for, S&P 500 or anything. So that's pretty much how all these trades will play out, right, in your favor. And, we're going to have a separate video on how to take, like money out mid trade, because you don't want to do like a 1 to 3 and like you went up to this amount of price and then price drops down and you're like, dang, I should have left with something given the fact of how big my take profit is. So that will be a separate video. So stay tuned. in the course for you for that. Okay, so I'm not gonna go too much into this, but let's briefly go over position sizing. So kind of the same idea. Once again, watch my last video, guys. I literally break down the math. You guys can like write it down in your notebooks, write it down in your fucking phone notes. Bro, it's there for you. You guys will never have to question how much am I risking according to my ticks on the S&P 500, on the NASDAQ, on micros, on minis. Bro, it's there for you. I wish someone told me that when I first started learning this. But here we go, okay? So position sizing and how it equates to your ticks, right? Briefly going over this because we already went over it basically. So this same 1-to-1 margin, right, would actually turn into a 2-to-2, but it's still a 1-to-1 margin. That's what makes it risky. And this is how position sizing can kind of make a difference. So that same trade, you know, for 100 ticks, meaning only $500, will now be $1,000, but you're also risking $1,000. And don't judge me, y'all. I know, you know what I'm saying? I had to make sure my math is right. I don't need anyone in the comments. Actually, 1% of 51,000 is 500. Get off my, you feel me? So had to, but yeah, variable risk kind of falls under that, you know, being able to really risk more contracts too. But you know, I wouldn't really mess with contracts if I was a mini trader because you're just risking so much for such a small amount of room to work with, especially on the NASDAQ. I would do that if you are trading micros though, because micros, you have a lot of room to work with, okay? So that's pretty much it. That's position sizing briefly, and that's really the details of risk management, the mindset. So I'm gonna make a quick segment on just the psychology behind risk management and how you guys can not let losses affect you. So quick little segment, guys, for risk management. Key things, write these down, okay? You want to make sure that you are okay with how much you are risking. If you are in a trade and you say, I have my stop loss at $750, but my day is going to be ruined if I lose this trade, you're probably risking too much. Tell yourself that. If the amount my stop loss is at is going to ruin my day if it hits, you are not risking a good amount mentally, okay? And then also the basics, you want to make sure you are winning more on your winning trades more than on your losing trades. Preferably. That's not a must, but that is preferably. If I was handing a baby a trading strategy, I would give it a strategy like that because it is more of a mental toll where you done busted your ass to win 2 trades in a row, and you understand if you lose the next 2 trades in a row, you are now at $0, my friend. So your strategy has to align with that. So I'm just saying, listen to me. Don't go through it. I tried the 1-to-1s. I tried the 1-to-2s. I tried the 1-to-3s. They all have their benefits. They all have their pros and cons. But the higher you go up in risk to reward, the more your win rate starts to drop a lot of the times. So be aware of that as well. And just make sure you guys are comfortable with what you're risking, bro. I can't stress that enough. I'll probably have separate psychology videos on just how to deal with losses in itself. But yeah, make sure you guys are risking a good amount. You know, like I said, it can be the dollar risk, the fixed one, right? You know, I'm on a funded account with Top Step. I'm gonna risk $500 every single trade, no matter what. Perfect, bingo, right? Maybe you're all about the percentages. You're more of a math guru. You're like, all right, I'm gonna just do 1%. That's fine too. Once again, though, you just have to deal with the prop firm rules. And then maybe you're more of a discretionary trader. Maybe you've been trading for, you know, 8 months plus already, and you're like, I have a strategy. You know, I'm just watching Nell's videos just because I'm just trying to get a little more insight on some things, or I need help with risk management. I'm making money with trading, but I feel like I could make more. I feel like I can manage my risk more. I feel like I can survive on accounts more. So maybe you're that type of person that would need to absolutely, you know, start to be a little more discretionary with it so that, you know, there's clear situations where you should only be risking like $300 because the market conditions aren't the best, but you're still risking your $500 because you're all about the fixed dollar risk and it's kind of fucking you over, right? Many different situations, to each their own. I can go on yapping about it all day, but that's pretty much it, guys. That is the risk management / position sizing video for you guys. All right.